Alright, yes guys, welcome back to the best channel on YouTube, the one that makes you money and goes straight to the point. Today we are discussing the difference between valid trades and non-valid trades. Now, it sounds very simple and something that everyone can grasp, but there is differences between a trade being valid, where we have a shift in market structure on both. Everything is aligned and everyone can see the model classed as the silver bullet or the 2022 model and the set of rules that I present to you guys on YouTube. However, there's a few minor mistakes that I've seen people make recently over and over again, causing them to have a lower win rate and take losses when they don't have to. Now, inside of this video, we are going to discuss all of that and we are going to go straight into it. Before we get into it, I just want to tell you guys about my new purchase. I've just bought 2 new 1-bedroom apartments, which are currently in development in Dubai. I've just put down a deposit of 14% of the total value, which is 1.2 million USD, and I've put down around 120,000 pounds, which I paid today. I'll put a screenshot up on the YouTube video now, which you can see like that. Ba-boom, ba-boom, ba-boom. So that's 2 new apartments. We got cigar lounges in there, you know, massage rooms, steam rooms, saunas, a cinema, everything you want, right? And I'm not actually living in there. I'm actually looking to go to a whole nother level, and that's crazy levels, right? And you know, if I spoke to myself 2-3 years ago, I'd be like, oh shit, I'd love to live there. But now we've got bigger ambitions. So each year, everyone who watches me on this channel grows and becomes better, better and better. Even people that I've coached one-to-one, they are now buying land, they're buying houses, they're taking payouts of 36k, 39k, 2.5, 1k, all over the place. It's absolutely amazing to see. I love to see it. Also, even when we started trading live as of the start of last week, I've already seen multiple people get funded. I even seen payouts already, and we only took 1 winning trade so far. So if you guys want to be a part of the live trading group, make sure you get inside. There's a link below for a 7-day trial to assess on your own terms to see whether you like the group or not. Now, we don't just discuss about the trades that we are taking. You don't just get to watch me trade live, but you also get access to all of the knowledge that I know personally about trading ICT. And not only that, but you also get access to real estate deals. Once you get paid out, you can get into real estate inside of the Discord, and you can also get into the crypto positions that I personally take myself. Now, without wasting any of you guys' time, let's get straight into the charts and break this down. Okay, so getting into price action, this is a trade that I took last week, and I've not had the time to get around to actually doing a overall trade recap for this trade, so I want to include this inside of this video as an example. Now, inside of this second day of macro on Wednesday, the 15th of October, as you can see here, price is obviously in a deep premium. So whilst you're in a premium, you can see obviously price has swept. If you head onto the 15-minute time frame, is that we've clearly swept points of buy side liquidity. Now to the left, you can see we're currently trading on Wednesday, and if you look at Monday's high, we've already swept the current weekly high. So now we've made a new weekly high for this current week. With doing so, we've also taken out points of London highs, Asia highs, the current weekly high, and many points of buy side. So that is very, very obvious. Now, starting on the 15-minute time frame, you are wanting to mark out all of the key levels that you can see presented in front of you for price. Now, a very obvious 15-minute low is, of course, just going to be this one. And because it's a non-time based low, such as London, Asia, etc., we can just mark this as sell side. And you're going to want to mark this out on both NQ and ES. As if we was to take a short position, this is going to be the overall draw for the trade. So for example, if we are looking for shorts, and let's say price gives us a valid entry to take, and we are targeting this point of sell side, if I then look at ES, and ES has already taken our objective of sell side but not on NQ, then that invalidates the trade with ES already meeting the objective, hence taking TP. In other words, taking TP before we've actually taken the trade. And very obviously, price has already taken out this point of buy side. So you can note this even though it's already been taken, just so we have that in the back of our minds and we know buy side has been swept. So now, with a sweep of buy side, I want to see, do we have a bearish bias? Now, when price takes buy side, we always want to see a bearish bias paired with that, and when sweep of sell side, we always want to see a bullish bias. Now, you're not always going to get what you want and not get exactly what the market is currently presenting, but we want to actually work our way down on the daily, the 4-hour, the hourly, the 15 and the 5, based off imbalances, and get a result for each one to work out our bias. Now, I'll explain this to you now on the way that we determine bias, which is the most high probability way in the whole of the ICT space. Feel free to backtest it. On the daily time frame, we're currently trading inside of a daily bearish gap, and we assume this daily bearish gap is respected until inversed. So the daily is bearish towards the next daily low or bullish gap. In other words, we are bearish until this new day opening gap from Monday opening up to Tuesday, and you can put the daily down as bearish. Now we're going to look at the 4-hour and get a result for each one. We're in a 4-hour bearish gap, so we're bearish to the next next 4-hour bullish gap or low. And this is how it works as we work our way down through each time frame, until we get a full picture and an overall bias leaning towards either bullish, bearish, or neutral. Because you're not always going to actually fish out a bias every single time. On the hourly time frame here, you can see that we are currently trading in an hourly bearish gap, and the bias is bearish on the hourly. Let's have a look at the 15-minute. Okay, so on the 15-minute time frame, you can see here we're not trading inside of a bullish gap, so we're either bearish or neutral, and we're trading inside of a bearish gap. So the bias here is going to be bearish on the 15-minute. Now, you only need actually 3 results out of 5 to have any sort of bias towards anything in life, right? Because that's going to be a fraction which is based above 50% at 60%, and we're currently sitting at 80% bearish bias. Now, dependent on the 5, whether it's 100% bearish bias, but that would be the strongest bias that you can possibly get, where majority of time frames do lean together. Now you can see here we're not in a bullish gap, so we're either bearish or neutral again, and you can see that we do have a bearish gap to the left, which the entrance to that gap is at 25,100. So if price has wicked above 25,100, which it has, it causes the 5-minute now to be bearish, and we're bearish towards the next 5-minute low or bullish gap. Essentially we're bearish until this next low at 25,075 on the 5-minute time frame. So as of now, this is actually the strongest bias that you can get, and we have a 100% bearish bias, and we have a sweep of buy side. So by looking at the checklist that we follow, a sweep of buy side must be paired with a bearish bias, which we have formulated here based off imbalances. And we have an internal sweep of buy side liquidity after this more or less accumulation period. So we've manipulated above a previous short-term high, also leaving a huge bearish SMT on ES, as ES is the weaker pair out of the 2 assets here. So the next step, which is step 3, is that we look for a shift lower in market structure without taking out any substantial lows, which invalidates the trade. So for example, we don't want to see a substantial low or a point of minor sell side being taken, such as this, which would then be going against the trade. So for example, if price displaces and then ends up taking out this point of sell side, it would then invalidate the trade. This is the mistake that I've seen many traders be making recently, is that price will actually shift market structure so heavily, ending up distributing. And there's a difference between a shift and price shifting and distributing without your entry. Now you need to understand, if you go onto the 5-minute time frame, for example, and you monitor the 5-minute lows for price, for example, if price was shifting lower here on the lower time frame, but then shifted enough to then take out one of these lows here, this is not a shift in market structure, this is actually a sweep of sell side liquidity. Now if you had a bearish bias here and this was inside of some sort of macro and we had a valid model, if price shifted below this low, this is now a sweep of sell side with a bearish bias. Now you must always have it like this. You must have a bias of bearish with a sweep of liquidity as buy side, and your bias must be bullish and have a sweep of liquidity as sell side. Now this is always the occurrence that you must see. And if you are seeing price action take out a point of sell side and then formulate a bullish bias, but then when you see it shift higher, it then takes out a 5-minute high or a 15-minute high, which is more substantial, then that is now a sweep of buy side, which is now going against the trade. That immediately invalidates the trade. Now I don't want to see people taking trades which we now have a sweep of liquidity against the trade. So if you monitor price here, let's look for a shift lower in market structure. As you can see there, we have a valid shift in market structure below 1-minute lows and not taking out this point of sell side. We do have a huge bearish SMT on ES and the objective has not been met. So we have displaced below this 1-minute low, and these 1-minute lows here is a shift in market structure on ES. A point of minor sell side that we would monitor on ES, for example, would be a low such as this. So this area is a shift in market structure. This here would be a point of minor sell side. So for example, if ES was to take this low, then that would invalidate the trade, or even this low. Same goes for this point on NQ. If this was to be taken with the shift, then it would invalidate the trade. So as you can see here on NQ, we have now shifted market structure below the previous low. So let's go back to step 1. We have a bearish bias, a sweep of buy side, a shift in market structure below a previous short-term low on NQ and ES. We now have a gap on NQ and ES. We have a order block which consists of a down close candle and an up close candle which engulfed the down close candle. This bullish order block has now been inversed but did not take out the high. Therefore, this is going to be a mitigation block. The difference between a mitigation and a breaker block is that a breaker block will take out the high high and then inverse the order block, and a mitigation will not. So hence why price moved higher, created a bullish order block, trades into it, but then inversed straight away, creating a mitigation. Now, if you have a mitigation on NQ but a breaker on ES, that's going to formulate a bearish SMT on NQ. Now, what you can see here, this mitigation block is exactly what we look for, as is paired with this fair value gap. This fair value gap here is a breakaway gap. Now, why do you need to know what a breakaway gap is? So a breakaway gap is a one candle formation in price that shifts market structure and also creates a gap in the same candle. Now, what you can do with a breakaway gap is actually run your stop placement at the high of the breakaway gap. But if you can, by all means, and in every single scenario, if you can run a stop placement less than 30 points and put it at a short-term high, this is always going to give you the highest probable scenario. However, there is some cases where a breakaway gap may consist of 30 handles, and running it at the high of the breakaway gap is your only choice, and it has to be at this area. The reason why I wouldn't run it at the high of the breakaway gap in this scenario, because your stop placement must be above everything that sends trade in favor. Now, what sends trade in favor in this case is the mitigation block and the breakaway gap, hence why my stop placement is above both of these areas at the short-term high for 18 handles. So I'm now looking to target the first 1 minute low that gives me as close to a 2-to-1 as possible. Now, you can see here we have a 1 minute low, but this 1 minute low is over a 3-to-1 risk reward, which is our max. Now, for example, if we have a trade which is over a 3-to-1 risk reward for the first 1 minute low or high in a long or short position, then what we do, we target a basic 2-to-1, and we understand that the first 1 minute low or the point of sell side, previous day low or London lows, whatever it be for that trade, is the draw. However, we only need to seek a 2-to-1, and that's what we stay as close to in all cases. Now, our absolute minimum for taking a trade is actually a 1.8 risk reward. Now, for example, you might find yourself looking at a position and it's either a long or a short position, of course, and the first draw on liquidity or the only draw on liquidity is, say, London lows, and after that you know that there is no points of sell side or buy side to target as of that position. So, for example, if London lows is at, say, this area here, let's say in a different example, let's say this was London lows, which it isn't, and this is less than a 1.8 risk reward. So, for example, if this was London lows and this was the overall draw for the trade, we would not take a trade which is less than a 1.8. However, if the first 1 minute low or high is over a 3-to-1, we just set it at a basic 2-to-1 risk reward. Okay, so for backtesting purposes, obviously on TradeZeller, it's not easy to get a clean entry as far as backtesting. So let's go to the next candle and see whether price gives us an entry off this fair value gap inside of macro. Okay, there you have it. So price gives an entry of an 18 handle stop. On my live account, I'll take this with 22 contracts and run my stop placement at that short-term high. TP is always going to be ran 1 to 2 handles above the point that you're looking to target if you are targeting a point of sell side. If you're not targeting a point of actual sell side and you're just targeting a generic 2-to-1 with no actual draw on liquidity, hence the draw is lower, then you set your TP at the 2-to-1 level and you do not put it 1 to 2 points above. As the reason why we put our TP, for example, if I have my TP resting at an actual point of sell side like this 1 minute low, I'm going to put my TP 2 points above at around 0.2100 or even 2150, as when price comes to this level, for example, if my TP is at smack bang on the point of sell side, there is more cases and more times than not that price will reach sell side, fill majority of orders, but won't fill yours because it's a limit order, and for a limit, you need to go at least around a tick through, especially if it's a large order of around 20 contracts. So it doesn't matter if you're on micros or you're on the full contract, running your TP just above the point that you're looking to target, if it is an actual point of buy side or sell side for your TP, then you need to make sure you run it above by 1.5 or 2 handles above. Now this is going to save you a lot of money by the end of the year, ensuring that your TP gets filled and it doesn't just tap the level where your TP is at and partially fill or not fill your TP at all. But for example, on this trade, we're actually running our TP in an area which is at a basic 2-to-1 with no point of sell side, understanding that the draw is lower but it's an overextended risk to reward, so we are going to set it at a generic 2-to-1. Okay, so now we also need to understand at what point do we go to break even and manage our risk on this trade. So from TP to break even, any low that gets taken past 50%, for example this low which I can see for price gets taken, this is where we trail our stops to break even. So let's fast forward price. Okay, so as you can see here, the same example of what I took when I was was taking this live in front of you guys, we formed a bearish order block, which you can see in for price, and the next candle likely will trade up into it and then cause more of an aggressive move lower, and we should start to see an acceleration in price. Price trades up into it, and then we see that aggressive move past that point of sell side, taking out our break-even point. So now we can trail our stops entirely to break even. Now, what you can see here, with that previous candle, we actually took out the first 1 minute low. Now, if I move that to the right, that first candle here takes out the first 1 minute low. Immediately, as soon as price takes out that first 1 minute low for the trade, we always trail our stops to the previous short-term high, minimizing risk by only a few points. This is a procedure that we always do. So as soon as you take out a low or create a bearish gap in favor of the trade past 50%, then you trail your stops immediately to break even to make the trade completely risk-free, which our break-even point, as far as entering live, would have been around 0.9175. So let's fast forward price. As you can see here, the exact same process to when I took this trade live, I got edged by a couple ticks from my TP. So as of now, being a few ticks away from TP, this candle here is a breakaway gap. So we have a displacement candle yet again with a fair value gap created in the same candle. So as I spoke to you guys earlier about this being a breakaway gap, I trailed my stops to the high of this breakaway gap, understanding that it should not trade back to this area. Price trades into the bearish fair value gap, creates another bearish order block, and then immediately takes out my TP, which you can see there. And I got filled for a comfy 2-to-1 on that trade. Now I'm going to show you another example of a trade that obviously came very close to my TP on Thursday, but didn't quite actually take the full objective. Alright guys, looking at Thursday the 16th of October as of last week, on the 15-minute time frame, we're going to start by marking out the key levels and see obviously which we've already taken out as of now. So we've taken out trading on Wednesday, currently trading on Thursday, we've taken out Wednesday's high. So we've already taken out a major liquidity level of previous day high. And then a very obvious low, which you can see here, is previous day low. So we're going to get that marked out. And then other important liquidity levels, such as this low, which is a very obvious low in price, and all of the points of buy side and sell side that you do mark out, make sure you copy and paste this over to ES to look for differences between the two assets, which can also work against or work with your trade in favor. So we have a very obvious bearish SMT on ES, as NQ has taken the high and ES has not. So ES is the current weaker pair out of the two. Okay, so now we've marked out the key liquidity levels. Going into this second day of macro, which we're already a few minutes into, you can see we've already swept buy side with a bearish SMT on ES. So let's formulate our bias starting on the daily time frame. You can see the daily's bearish. The 4 hour is going to be bearish. So we traded out of the bullish gap and then we've traded into only this bearish gap after taking the high. So we're bearish on the daily, bearish on the 4 hour. We are on the hourly time frame. You can see that we are bearish. So we've already formulated a bearish bias. So on the 15-minute time frame, as you can see here, we have a 15-minute bearish gap that is likely, of what I can see here, been inversed. And then the bearish gap resting above is an entrance at 19575, which has not been traded into. So as of now, with the inverse of the 15-minute bearish gap, the 15-minute is bullish, so the daily is bearish, the 4 hour is bearish, so either way we still have a bearish bias, and on the 15 is bullish, and the 5-minute, well, let's take a look. The 5-minute, as of now, is going to lean towards bullish. So we have an intraday lower time frame bias of bullish and higher time frame as bearish. So we have a 60% bearish bias, which makes this sweep of liquidity valid and leads us on to our third step, which is a shift in market structure. Okay, so points of liquidity to watch out for this trade, and if they are taken, it would invalidate the trade, is that we've shifted market structure below this 1 minute low, and this is not a substantial low because this is actually a bullish order block that got inverted, which is paired with the gap on ES. So that's actually a confluence with taking this low and inversing this bullish order block, which is actually paired with this fair value gap. Points of liquidity that we do not want to see get taken, which would invalidate this trade, is this 1 minute low, this 1 minute low, and the same one on ES, and also this 1 minute low. So now we want to see our third step. So step number 1 is that we have a bearish bias. We have a sweep of buy side for step 2, and step 3, we have a shift in market structure below a previous short-term low on NQ and also on ES. We also have, as you can see here, a fair value gap, which is a breakaway gap. This candle displaced and created a gap in the same candle on both NQ and ES. And then obviously we have this order block to the left, which is a bullish order block, which got inversed from price closing below it, which is also paired with this gap after taking the high. So this is going to be a bearish breaker. So now we are going to look for an entry of shorts inside of this macro off this gap, and our point of TP, which you can see here, I'm going to run a stop placement above anything that sends trade in favor. Now the shift in market structure occurred as of this point. So we are looking at points which will send the trade in favor here, including this bearish gap and the breaker block. So I want to make sure that my stop placement is above anything such as the bearish order block, the breaker block, and the fair value gap for this trade in order to be valid. Running my stop placement here at the high of this candle. This fair value gap here is not part of the trade. We shifted market structure as of this point. We have a gap, a breaker block, and an order block here. Price should not trade above this area for price. Hence why my stop placement is at the high of this candle. And then our TP is going to be at the first 1 minute low for a 2-to-1 risk reward. As you can see here, we're currently sitting at a 3-to-1 risk reward, which is slightly more than we actually want. So we're going to target a basic 2-to-1, and we're going to set our TP at 0.71. So let's see if we get an entry off the gap for price. All right, perfect. So price trades into the gap and gives us an entry. I'm going to take this with 18 contracts on my live account, as I did when I took this live. You guys can all reference these trades on my YouTube channel as well, so feel free to take a look at those trades as well of when I took it live. And then the TP at 0.71, you can see there. Let me just make sure it's dead on. All right, perfect. So let's fast forward price and see how we manage our overall risk. From TP to break even on the trade, any low taken past 50% is going to be where we trail, obviously, to break even. So this low that we marked out earlier is going to be our point of break even for the trade. So we just put in a bearish order block for price, respecting this bearish order block, which you can see there. Okay, and as you can see here, we've just taken out the first 1 minute low. So we are going to be trailing our stops immediately to the first most recent high on NQ that we created. It has to be a swing high on the 1 minute time frame. Okay, so as you can see here, we took out this first 1 minute low past 50%. So we're going to be trailing our stops all the way to break even on this trade, which a live entry was at around 127.00. So it's completely risk free on this trade. As you can see here, we came very close to being at the area of our TP at 0.7425, only 3 ticks off, and I ended up trailing my stops further to the previous high, which is at 12425, only 3 points past my original entry point. And as you can see here, price came back to the previous high and ended up taking me out of that trade, and I got a very small and slight win on that trade for a plus 0.2R. So very small, but risk was very well managed, and we ended up closing that week for a plus 2.2R for the group. Many people got funded. I see in quite a few payouts as well, so it was very good to see. Now I hope you guys have enjoyed this video, understanding on when price shifts market structure, that if it takes out a substantial or even a point of minor sell side or buy side in a long or short position, usually showing on the 5 minute time frame as a 5 minute low or high, then the trade has now been invalidated. So hopefully I've got this point across to you guys, and you guys have more of a full understanding on what you're looking for inside of the AM session of trades I've also taken myself. And until the New York AM session tonight, I wish everyone to have a great evening or morning where you are watching this video. Subscribe to the channel and drop a like if you want to see more videos like this. And for future videos on this channel, make sure you drop a comment, as I do read all of the comments that you guys put on there, and I ensure that any solid good requests of comments put on this video shall be inside of the next video 100%. And until the next one, guys, take it easy.